Okay, the federal discount rate. Let's talk about this and get introduced. I'm not going to run through too many questions in this lesson like I do in other ones. This is more just talking about everything, making sure you know the background and you don't have any misinterpretations of terms or concepts. When we talk about the Fed, let's start here. The Fed, also known as the Federal Reserve, could be known as each. I'll call it the Fed. It's much more abbreviated. It was created in 1913. Now, it is not controlled by the federal government. This is something that people get confused by. It's not like the president can say, "Hey, Fed." I mean, okay, maybe they can in reality, but on paper, how the government's supposed to run, the Fed is independent, independent of the government. It can do whatever it wants. Now, you might think that's kind of crazy. There's this independent body, right, just kind of doing its own thing. Well, that's how the system works. I'm not going to go too much into depth about that, but created in 1913, and the Fed is the entity that prints money and controls monetary policy. And we'll see in a second. I'll talk about that next slide. The federal government controls fiscal policy. Don't worry about that. We'll go over that much more in depth in the next slide. Now, this is just FYI, giving you a nice introduction, background. You don't need to memorize these by any means. I can guarantee that. We've got 12 districts. Now, each of these cities is where the office is located. But if I showed you a map, and you don't need to know the map, no worries. The Richmond district takes over a bunch of states. St. Louis takes a bunch of states. Dallas, etc. So this is where they are all located, and that's that. Just for an FYI. Now, the federal discount rate. Now is where we're getting into terms you really do need to know, not just background. This is the interest rate that the Federal Reserve Bank, the Fed, charges banks, Chase, Bank of America, to borrow funds from one of the Federal Reserve Banks. Let's talk about this. We've got Chase, and this is just how it works for the test. Maybe you work in this industry and it works differently, but I teach you for the exam because you got to get through it. All right. Now, Chase, oh no, we need money. We overlent and we need some cash. So Chase calls up the Fed, says, "Hey, we need $1 million." Maybe the federal discount rate right now is set at 1%. Cool. Chase borrows $1 million from the Fed at 1%. Then Chase goes and lends it out to you for 1.5%. And yeah, essentially that's how it works. Awesome. Now, it is set by the Fed's Board of Governors, and it's a monetary policy tool. Now, okay, you might hear talks of interest rates. I mean, gosh, it's just always up in the news depending on what's going on in the world. Increase interest rates, decrease interest rates. That is a monetary policy tool. If you are familiar with the 2008 financial crisis, if you're familiar with the dot-com bubble or the pandemic, any of those larger events, the Fed steps in, the federal government steps in, the Fed conducts its monetary policy, and the federal government, and I know that can get confusing, but just stay with me, the federal government conducts its fiscal policy. So this is the interest rate that the Fed charges on loans. It is not the federal funds rate. We'll see what that is in a second. Lending at the discount rate is part of the Fed's function as a lender of last resort and is one of the Fed's primary monetary policy tools. That is, like I said, it's a tool that they use to help stimulate or tamper down the economy depending on what their intention is to do. Now, the federal funds rate, this is the interest rate that banks charge each other for loans that are used to manage reserve requirements. Now, what's the reserve requirement? Generally, let's say it's, because it changes. It does change. A lot of this, and what's interesting is a lot of what I'm talking about could, depending on when you're listening to this recording, could be applicable to what's going on in the world. So it's very relevant to everyone's lives. This reserve requirement, sparked by the Great Depression and the run on the banks, right? We want to make sure that the banks have enough cash on hand to pay out anyone who wants their cash at any point. We don't want to run on the banks, and the banks have no money. Now, we don't want the banks to have to hold every single dollar that we give them, because banks can then take the money they hold, lend it out to people who want to start businesses, right? That's how the economy flourishes. That's how credit works. That's how we grow and develop our economy. Is I give the bank $100. Now, they don't have to keep the $100. If let's say the reserve requirement is 20%, they have to only hold on to 20% of my $100. They can loan out the $80 to someone down the street who wants to start a small business. I'm saying that in how the ideal world works. Obviously, the banks do with it what they want. A lot of times they just take your money and make lots more with your money. All right, so that's the reserve requirement. It's been at zero. It's been higher. It depends. The reserve requirement being at zero means that I give them $100, they can lend out all $100. Now, if there's a run of the banks, it's a little risky because now I can go in and say, "Give me my money." They don't have the money to give me, and then it's a big mess. They gotta get Chase has to get money from Bank of America or from the Fed, right? It's a whole process. You see the pros and cons of everything, though. I mean, you lower the reserve requirement, it means more money can be pumped out into the economy and invested. You increase the reserve requirement, it's more of a safe measure because you're not going to have a run of the banks and people demanding their money, and the bank doesn't have the money. Yeah, I mentioned that. Let's say it's 80% they lend out. That's the metric I used. Helps the economy with extra liquidity because you need a loan to start a business, buy a house. The more money, the more businesses being started and houses being purchased, the better the economy can flourish, and it prevents bank runs. This was a nice introduction. Just to recap it all for you, over here, this is just for your information. It's not like you have to memorize anything, but especially this. But just the Fed, know what it is. It's a separate entity. The federal discount rate, this is when they talk about raising interest rates with the federal government, not the federal government. Yeah, you can tell we're going to have a fun time with this. The Fed, the Federal Reserve, that is our interest rates increasing and decreasing. Federal funds rate is the interest rate that banks charge each other. So Bank of America wants to uh, charge Chase 2%. Reserve requirement, we went over that. Nice little introduction. Now let's get into some monetary and fiscal policy.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.Examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.